You've worked your whole life to get here. The last thing you should worry about is running out of money. Safe Money Radio, real strategies for guaranteed retirement income. I'm Brett Blake. Let's make sure your money lasts as long as you do. Ladies and gentlemen, welcome back to Safe Money Radio. My name is Brett Blake. I'm your host of the show. And I'm excited today to have a guest who has become self-made, if you will, at a very young age. Our guest is Todd Tresidder, the founder of Financial Mentor, a former hedge fund manager, financial educator, an author, and the host of the Financial Mentor podcast. Todd retired financially independent at just 35 after building wealth through disciplined investing and risk management. Today, he teaches investors how to make smarter financial decisions, build sustainable wealth, and pursue financial freedom based on proven principles rather than popular myths. Todd, welcome to the show today.
Thanks for having me.
You bet. You know, I just want to kind of say, I think I have had individuals who have been authors, and I have individuals who are financial planners. You've kind of taken a different approach. Rather than trying to invest people's money, you're an educator. You're trying to teach them. You're trying to make them smarter and align your interests with theirs. Is that a fair shake?
Yeah. So I cut my teeth. I was one of the early pioneers of quantitative investment management. So, computerized trading systems. So I did that back in the days of the IBM PC, the first one with the 8088 processor chip and a 10 megabyte hard drive, which is now nothing. But that was huge back in its day. And I had to, they didn't even have data sets back then. I had to hand key punch in the Dow Jones Industrial Average. There was a book out called Dow Jones Averages from 1885 to 1985. Or I think it was back 1980. And I had to hand key punch in every data set that I used. And I developed quantitative trading systems. And they worked. Where it came from was I was in an investments class when I was in college, which for anybody looking at the video clip can tell that was a long time ago because I'm very gray-haired and wrinkled now. But back then I was in this investments course, and it's a very conventional investments course, teaches all the conventional wisdom, just as everybody else learns in business school or in college or whatever, or you learn on the internet. And so I was learning all that stuff. And I remember there were some charts in the book, like you see, right? Price time charts. And they're often called mountain charts in the industry. And I was looking at these charts of different things that people were investing in. And I just looked at it and I go, you don't have to know anything about that to profit from it. I could just do that with math. And I mean, it just seemed obvious to me. And I went up to my professor, who was a known successful investor. I mean, he was definitely an authority figure, and he wasn't just a clown. He wasn't just a clown professor. He knew his stuff. And he looked at me and he said, "Well, that's impossible, Todd. You can't do that. Nobody's ever done that." And this was right at the beginning of computers, right? And PCs. But it was just obvious to me. I mean, if you looked at the chart and you knew anything about statistics, there was a way to do algorithmic trading with it. It didn't take a genius. At least back then it didn't. Now it's very competitive. But the stuff I developed back then still works today. It's still some of the best stuff today because the really simple truths hold up well because they capture a fundamental truth of how markets trade. You're not doing some little data tease. You're not teasing something out of the data, but rather you're capturing a fundamental financial truth and presenting it algorithmically. So what that does is that gives you math discipline to your investing. So I thought, well, gee, this sounds obvious. So then I went to the only other investment authority in my life, which was my father. And he was an investor. And I went up to him, I says, "Hey, Dad, I was taking this investments course and I looked at this and it seems obvious to me. You don't have to know anything about this. You could just do it with math." And he looked at me and says, "You can't do that. Nobody can do that. It's never been done." And that was all I needed. At that point, I knew it was good. And then so I went off and did it. And it worked. So I was one of the early pioneers of quantitative investment system design. And the stuff I developed back then still works today.
And a great lesson for anyone wanting to be an entrepreneur out there. If you get two bright people telling you it's not possible, it's probably you're on the right track.
Well, it was the reasoning. They didn't address what I was actually saying, which seemed true to me. They were just telling me it couldn't be done. Like they had such a block to their vision of what was even possible that I looked at, I said, they have no idea what I'm talking about. Like they don't even understand the worldview that I'm coming from. And I'm looking at, they're not invalidating it. Just because they're saying it won't work doesn't mean it won't work. It just means that they don't understand it. And so then I just went through and tested it more, and lo and behold, it worked. It worked brilliantly.
And so I'm excited about today's conversation because, when we talk about Safe Money Radio, everyone kind of thinks, okay, that means X. But we're going to talk about some myths, market myths that I think will truly help retirees safeguard their money in ways that most of them haven't thought about. In fact, are in some ways contrary to what they're being taught by others. But before they do that, I just want to talk about, you're down this road of knowing I can apply math, I can apply electronics and these new computer systems. You go into the hedge fund world, you do extraordinarily well. At 35, though, you make a shift in your career. Can you just talk about what that was all about? What happened? How did you get from the hedge fund world to the education world and what you're doing today?
Well, it was an incredibly stupid decision from a financial standpoint, right? Because I was going to get paid the most I'd ever get paid in the hedge fund business, running money. But what I found was I had spent about 12 years of just almost full-time research. Um, I was paid, we called it the $100,000 garbage pile. And what it was I was paid to acquire any algorithmic approach or even non-algorithmic. And I was supposed to put numbers to it to prove if it worked or not. And my job was to figure out what worked, what didn't in the financial markets. And surprisingly, almost nothing works. There's very few things that will beat buy and hold. So buy and hold is a valid investment strategy. And there's a reason why it's valid. So I define valid, first of all, we should define that term. Valid is it has a positive mathematical expectancy, so positive expected return net of transaction costs. Okay, so that's what defines a valid investment strategy. And so buy and hold is valid. That's why it stood the test of time. That's why it's the mainstream wisdom. But that should never be confused with being efficient or being smart or being the best choice. It's valid. But surprisingly, very few things improved upon it, but there were a select few things that did improve upon it. And they all had something in common, which was they were centered around risk management, which is completely contrary to what people think. People think investing is about finding a great investment, right? Everybody thinks in terms of offense. I need to find the next great investment. And in fact, I mean, this ties into your moniker, right? Safe Money Radio. The real centerpiece of it is risk management. And there's a math reason why that's true. It's really obvious when you think about it. Let's use the sports analogy, stay with the sports analogy. In professional sports, for any sport you like, it could be World Cup, it could be US football, it could be basketball, it doesn't matter. Is the championship team ever the top offensive team in the league? And I'll quick cut to the answer. The answer is no. They're usually in the top echelon on offense, but they're usually not the best offensive team. The key characteristic is they're in the top echelon, both in offense and defense. They have a great defensive play as well as great offensive play. And it's the balance of the two that creates a championship team. The same principles apply to investing. You have to have an offense that will put points on the board when there's opportunity in the markets, but you have to have an equally great defense that protects your capital when times are tough, when there's adversity in the markets. And the reason for that, let's go back to the sports analogy. When you have a great defense, what happens? You control the ball, right? If you don't give up many points when you're on defense, then you don't have to score very many points on offense to win the game, right? So again, we're talking about winning the game long term, which in investing terms is putting points on the board, is compounding your, compound growth.
Right.
Right. If you lose a lot of money, it takes a lot more to get back to even. It takes a lot more to win the game. And so we'll go to math. The funny thing about compound growth mathematics, and this is where it all came in, why it's all about risk management, is it's asymmetric. So in other words, a 10% loss is only an 11.1% gain to get back to even. There's not that much difference, right? So you start with 100, you go down to 90, your compound growth on 90 is 11.1% to get back to 100, right? To get back to even. 25% loss, 33% gain to get back to even. 33% loss, 50% gain to get back to even. You should be noticing something
Yep.
now.
Yep.
A 50% loss is 100% gain to get back to even, and a 90% loss is a 900% gain to get back to even. So what happens, you'll notice if you plot it, this asymmetric graph, is that there's kind of a death zone. And it's kind of in that 25 to 33% range. If you lose too much at any one point, really kind of in that 25 to 33% range or worse, it's really hard to recover. Now, real world is actually even harder than that, because in the real world, you've got inflation, you've got transaction costs, all these things are headwinds. Plus, if you're retired, which everybody, the only reason they save money is because they want to be able to retire on it, right? And pull a
Right.
safe withdrawal rate. So if you're pulling capital during this period when you're trying to get back to even and you're going through a drawdown, it adds insult to injury to the drawdown. So there's an old saw in conventional financial wisdom that says, you just absorb the volatility, you absorb it, you just buy and hold through thick and thin, stay disciplined, all these terms, right? Well, let's use an actual example, the 2000 decline. Okay, the losses in that, it took till 2012 before the S&P recovered and started to new highs. So conventional wisdom is correct. The market went to new highs, just as they claimed. But if you're a conventional retiree using conventional wisdom of a 4% rule, you're still down over 50% before you adjust for inflation and volatility effects. So the market's going to new highs, but you're wiped out, right? Because you're working with half the
Right.
portfolio and you're trying to compound your way back to even. The market's already getting to new highs. And if you start factoring in volatility effects on that, it's even worse. So the point is, there's some math truths that underlie how smart investing works. And the underlying piece is that defense is actually the key, controlling losses. You have to have a valid offense. I'm not saying offense is not important. It is. But it's not how people think about it. Everybody thinks it's about a good investment strategy. I need a good investment. I need to find the next Microsoft in its infancy. I need to find the next AI company before the AI bubble erupts, right? Like there's all these beliefs out there, and that's not actually the way it works in the real world.
So you're kind of bucking the wisdom of, like you said, buy and hold is a great strategy. It's hard to build that, but buy and hold isn't a ignore all risk kind of moniker to you. It's buy and hold, yes, but there is times when you exit the market, right? Is that what you're saying?
No, but
No.
I'm sorry. Let's clarify. You were
Yeah,
defining
please.
buy and hold, and then you were saying what I was saying. So let me just
Okay.
try to clarify here, okay?
Yeah.
Buy and hold by definition requires you to accept market risk in order to get a market return. That's the
Okay.
definition of buy and hold. You accept market risk at all times to get a market return. And so market risk, depending on the research study you look at, but let's just take a low, it's anywhere from 80 to 90% of the remaining risk on a properly diversified portfolio. So it's market risk is the game. It's the tail that wags the dog. It's the reason you have all the volatility in returns. If you weren't accepting market risk, there wouldn't be the big volatility in returns. And if it wasn't for the huge volatility in returns, there'd be no need for us to talk. In other words, if market risk was contained like in recent years to, 10% down moves, even 20% down moves, then there wouldn't be any need for risk management because they're not violating the asymmetric math of compound returns, right? It's
Right.
only because market risk is much larger than that and will probably be in the future, right? It's been contained by Fed intervention, but the government's not in the same position it's been in the past, right? The debt problem and the inflation problem, the Fed's hands are fairly well tied right now. They will try, but then inflation will be the outcome if they try to bail it out like they have in the past. So, for people that think that market risk is contained like it has been in the recent past years, they need to look at deeper history to really understand what they're buying off on. And you only get one mistake. That's the funny thing about compound return math. You can destroy a lifetime of compounding in one bad move. One bad move. And people don't understand that. And then conventional wisdom says, well, Todd, so what? The market always comes back. Well, we've already addressed that. Yes, the market does come back. There's a reason why. The expected return from a stock portfolio is dividends plus economic growth plus or minus change in market valuation, right? And if you hold long enough, what happens is that third term, plus or minus change in market valuation, mean reverts. It goes to zero, right? Because you have bull market, bear market cycles. Those are driven by changes in market valuation or market risk, which is what I was talking about earlier,
Right.
right? And so that third component of the return equation zeroes out, but it drives all the volatility, right? And so then you end up with a return that is dividends plus economic growth, which is the long-term return from holding stocks. And so that's a function of when you enter the market. If you acquire your portfolio at high market valuations, then you have a lower first component of the return equation, which is dividends, because dividends are inversely correlated with the valuations at the time you buy it, right? So you end up with a lower long-term return if you start at a higher value. Well, gosh, that's exactly what the data shows,
Yeah.
right? If you acquire a portfolio from a high valuation, you'll endure more volatility and have a lower long-term return. Conversely, if you entered the market and began your buy and hold portfolio from a lower valuation, but note, you'd have a higher long-term return. But notice what that's sounding like. That's sounding like market timing, isn't it?
Right.
Because you would enter at a higher valuation or a lower valuation. That's market timing. That's voodoo in the world of conventional financial wisdom, because they say nobody can time the market, right? But one thing you want to notice in that is they don't define market timing. They don't even define what it is. It's this term that everybody tosses around in the business, but people don't define it. And so if you carefully define it, and let's say market timing is defined as a methodology that attempts to profit from forecasting the future of the markets, right? Like you're trying to buy the market before it goes up, sell it before it goes down. If it has some forecast component, then they're right. It's voodoo. Nobody can do it. Nobody knows the future. The future is unknowable. However, what you can do, and this is what I found in my research, this is going back to the $100,000 garbage pile, right, that I talked about earlier. What I found in the research is you can do it with validity and with confidence using statistical risk management. So there's mathematical algorithms for risk management that work consistently and reliably. Now, what's funny is it has the look from the outside like it's market timing. It looks because you're buying and selling the market, but in fact, it never knows the future. It forecasts nothing. There's no statistical validity to its forecasting ability, and yet it works beautifully in terms of reducing risk and increasing compound return, which effectively doubles the safe withdrawal rate over conventional buy and hold. And it does it all by controlling the downside. It's controlling with risk management. And it just has to do with the asymmetric math of how wealth compounds. When you control those large losses, if you think about it, buy and hold gives you a distribution of returns for stocks and bonds, right? It includes all the distribution of returns. So then what happens is if you do statistical risk management through tactical asset allocation, what you're doing is you're effectively cutting off the far left tail of the distribution of returns with mathematical precision. And so it's leaving the right-hand side of the distribution of returns. And the far left tail is where all the major losses are.
So you're saying, this idea of ignoring volatility, staying in the market, it's not the wisest move, but neither is trying to predict the future unless you have a tool, and the tool you're talking about is this being able to use the statistical analysis to really be able to say, okay, this is how the market has performed over time. Statistics tell me when it's here, it's going to go here next. Am I getting this right?
You're close. It's even simpler than you're saying.
Okay.
Here's the idea. You can't have a 10% loss. And I'm not saying this is the number. This is how it works.
Yeah.
I'm giving an example to show the concept. You can't get to a 10% loss in your portfolio if you exit to cash every time it gets to 5%.
Okay.
You just can't do it mathematically, right?
Right.
Because you stop the losses at 5%. So that's the principle. Now, obviously, the practical application is more complicated. It's not that simple, because supposing you exit at 5% and then it goes immediately back up, right? So there's nuance to it that has to be understood to do it intelligently. I'm not saying it's that simple, but the principle is that simple, right? It goes back to that Mark Twain quote. Remember that old Mark Twain quote? Um, I'm going to paraphrase it, but it's basically investing in stocks is easy. If let's see, if it's going to go up, buy it. If it don't go up, don't buy it. Something like that, right?
Yeah.
Like it is some sort of,
Oh, okay.
yeah, but in fact, that's the way it works. That is in fact the way it works. It sounds so ludicrous the way he said it, right? Because he's a humorist.
Right, right.
But really at the core, it's valid what he's saying.
So this is kind of what you're talking about, what you're teaching, is kind of the core of your expectancy wealth planning course. This course that actually educates individuals and gives them the tools to be able to be wise in terms of managing their portfolio, not ignoring volatility, and kind of knowing how to cut off that lower end market drops in their portfolio. Am I right? Is that the essence of that course?
Yeah, it's called it's called expectancy wealth planning, which is built on mathematical expectancy for a reason. Mathematical expectancy is the equation that determines the compound growth of your wealth. And expectancy analysis is also practiced by casinos and insurance companies because it's how you create confident outcomes in uncertainty, right? So like an insurance company, an actuary, they know the data, but they don't know what's going to happen on any one policy, right? You could have a policyholder who buys a life insurance policy and he dies the next day, in which case they lost a bundle on that policy. But they know statistically over a large sample size what will happen with a certain vetted policyholder group, right?
Right.
That they have to do applications and they understand certain rules. They don't take smokers and they don't take other high risk individuals who are parajumping off of high rise buildings and things like that, right? So they have all these exemptions to control their risks so that they get a statistically valid thing. So then they set the premiums and they know with certainty that they will profit from that sample size of those policy premiums. So what the course does is it goes through financial planning from soup to nuts, including investment strategy, which is the thing we've talked on so far.
Yeah.
And it looks at it looks at it from an expectancy perspective. And the beauty of expectancy, see, the future's unknowable. The whole premise of the course is nobody knows the future. I don't, you don't, none of the experts on TV know it. And certainly your advisor doesn't know it, even though they'll pretend to know it.
Right.
Right. And so what this does is this says, okay, and let's redefine investing also. Investing in my world, in my course, I call it putting capital at risk into an unknowable future. That's what investing is you're putting capital at risk into an unknowable future because that's exactly what you're doing.
Yeah.
And so how do you do that with confidence? That's where the crux is. And there's a whole instructional base that builds up to that, to where you can do that with confidence and you can profit during widely varying market regimes.
Awesome. And this class is available, by the way, for those of you who are just tuning in, at your website, which is the
financialmentor.com.
Financial Mentor. Yeah, I wanted to say founder. Financialmentor.com.
Yeah, so it's two words mashed together, financialmentor.com. And then up in the top menu, I have like 5 books, and then there's a course in there. There's one course, and it's called Expectancy Wealth Planning.
Awesome.
And they can see it from the products menu.
Okay, let me go back to a common, top for especially individuals thinking about retirement. They've saved amount of money. They've got this portfolio of money. Now the question is, well, how much of this can I spend? And usually that people go to a kind of the rule of thumb is 4%. You can spend 4% safely and reliably and withdraw that, and that'll last you for the rest of your life. What is that true? Is that what's right or wrong with that philosophy?
Well, it's not wrong, okay, but there's more to know about it. Okay. So safe withdrawal rates, the research that founded the 4% rule was done by William Bengen. He has since adapted it and pulled away from his original research because he's learned more since then. And he's got subsequent books more recent. But basically, the idea is that you could take 4% of your original portfolio when you retire and spend 4% of it in perpetuity adjusted for inflation. So you can raise it with inflation over time. Now, the interesting question on this that almost nobody seems to ask is, why is it that if I have a passive portfolio, passive buy and hold portfolio that historically has earned anywhere from 8 to 10%, depending on the time period and what assumptions you put in those numbers, why is it that a portfolio that earns 8 to 10% can only pay me 4% adjusted for inflation?
Yeah.
That seems kind of crazy, right? Like, you would think you could spend at least your return, not to mention some of the principal. So why is it half the return or less?
Right.
And there's a reason, which is the reason is unmanaged volatility or market risk, right? That causes the things that you'll find in the literature called sequence of returns risk. And if you enter the markets, if you enter retirement, I should say, not the markets, if you enter retirement in front of a sequence of returns period, an adverse sequence of returns, then it lowers your portfolio value. That's what we talked about in 2000. Imagine the person that retired at the 2000 top, right? Um, the It lowers your portfolio value from volatility and market risk at the same time that you're spending that 4% and then raising that amount every year for inflation. And so while the portfolio is trying to recover, you're dinging it and spending away from it, and you end up with math that's very different from what is commonly taught. And so there's a couple principles to understand in this. One is volatility. Conventional wisdom tells you that you should ignore volatility, right? Because the market always comes back. That's not true. They treat it dismissively because they don't have a solution for it. They have no way to manage all the volatility caused by market risk. But in fact, volatility is something you have to manage. And this isn't Todd's opinion. It's provable mathematically. There's a thing called the volatility tax, and it can be computed. So for example, I'm just going to give a really stupid, simple example just to
Yeah.
illustrate the point.
Yeah.
Let's say that you have 2 years of gains and losses. You have a 50% gain and a 50% loss. And so, your average return is 0, which is how most people think about it. They gain 50%, they lost 50%, right? Doesn't matter which order it occurs in. Your compound return is negative 25%, right? So you went from $100 to $75 because you went from 100 down to 50, and then 50% on that is 75.
Right.
So there's a difference between your compound growth and your average growth. And that difference is a function of the volatility involved in that path. See, that was a very volatile path, up 50, down 50. If you had T-bills, there's no volatility math involved. You can spend, for your safe withdrawal rate, you can spend the interest earned on the T-bills plus a little bit of principal. You can actually spend more than the interest. Why is that? Because there's no volatility in the return stream. You're getting all the return. There's no volatility involved. So what happens, the way it works when you're calculating safe withdrawal rates, is the compound annual growth of your investment strategy is the ceiling, if you will, that the safe withdrawal rate can aspire to. Okay. The volatility of that return stream, the path to get there, determines the gap between the safe withdrawal rate, the amount you can actually spend, which is the only thing you actually care about as a retiree,
Right.
and the compound annual growth. So like stocks and bonds are very volatile return streams. So it has this massive gap. We started with that. It's like, 8 to 10% compound growth and 4% safe withdrawal rate. So you've got this massive gap. T-bills, no gap. You can actually spend more than the return stream. So the compound growth or the return sets the ceiling on your safe withdrawal rate, and the volatility determines the gap between the compound growth and the actual safe withdrawal rate, how low it is. And so that's the volatility tax. It shows up in the compound growth, but it also shows up in the safe withdrawal rates. So when conventional advice tells you volatility is something to ignore, they're wrong. I mean, they're just flat out wrong, and it's mathematically provable. Okay, this is not subject to discussion or interpretation. It's just wrong, and it's conventional wisdom everywhere. I mean, the reason they tell you to ignore the volatility is because they have no solution, right? Because the definition of passive investing is you have to accept the market risk at all times to get a market return. If you're investing under that assumption, you can't manage market risk. Therefore, you are subject to the whims of the market at all times. And that's why people feel uncomfortable. Retirees, investors, they inherently always feel uncomfortable because they know they're always at risk. It's not managed, it's not controlled.
So we're in a so I love this idea of a volatility tax, and that volatility tax is really the explanation of the difference between what your portfolio can make, has made traditionally, and how much they're suggesting you can withdraw. And I hadn't been explained as clearly as you explained it, how removing the volatility tax actually increases the amount you can withdraw from the money you have. And it's interesting, I've seen statistics showing that so many people retire and they've built this mountain of money to go and retire on, but they don't dare touch it because they've experienced volatility in the past. And the last thing they want to do is run out of money, right?
Absolutely. They're fearful, right? If they lived
Yeah.
through the 2000 decline, like anybody retiring now, they lived through the 2000 decline, they lived through the 2008 decline, 2018 decline, 2022 decline. They understand it's possible. And every one of those was interrupted by Fed intervention. What happens if the Fed can't come to the rescue?
Yeah.
Supposing the Fed's hands are tied and they can't rescue it, what happens then if we actually go through a full liquidation event, as the markets have been trying to do for a long time, but the Fed's been interrupting? At that point, it's life-changing, and it only has to happen once. That's the problem. You could do the right thing and diligently save and do everything right, and then you incur this large portfolio drawdown, and it alters your life trajectory through
Yeah.
no fault of your own. It's just, again, the conventional wisdom is not entirely wrong. It's a dangerous half-truth. That's why I opened up. I said buy and hold's valid. I'm not saying it's not valid. I'm just saying it's not smart. It's accepting way too much risk. And I get that it's conventional wisdom, but math is math. I mean, this is financial math and it's inviolable. These are not Todd's opinions. It's all provable. I've got students in my course who they would never do this, but their portfolio shows 8% plus safe withdrawal rates. Now, they're coached to be conservative because the nature of safe withdrawal rates, you'll always have to be what's called to the left of the curve,
Yeah.
right? And this comes from Porterville optimization math. You always have to be the left of the curve because if you go to the right of the curve, you blow up, right? So if you show a safe withdrawal rate of something like 8%, which is twice conventional wisdom,
Right.
okay, that means you either have twice the lifestyle for any given amount of savings, or you can have the same lifestyle you want on half the savings. Okay, that's life-changing.
Yeah.
Okay, and it's real. It's math, it's attainable, it's proven. And so, but it's not conventional wisdom by any stretch.
By the way, Todd won't say this, but I'll say this. What you just heard from him, the difference between 4% and 8% surely validates the value of that class, no matter what he's costing, no matter what he's charging for the Expectancy Wealth planning course. Todd, let's talk about today if you can. I want to try to apply this to what's going on today. It feels to me like we're in this weird place from the standpoint that the markets, although there's some volatility happening just recently, but the markets have performed pretty good over the last little while, despite the fact we've had just tremendously crazy things happening in the world with wars and oil prices and inflation and living past COVID. We now are having conversations of some people are talking about AI, and AI is going to see these $1 trillion valuations, and 6 months ago they were talking about crypto taking over banking and other things. There seems to be so many variables happening in the world at this time, and yet I don't see the market responding yet to all of that. It seems to be somewhat insulated. Do you think that's a sign that the market's changed in some way? Do you think that we're living in kind of a little bit of a falsetto in terms of what's supporting the market? If you're guiding individuals, if you're thinking about it right now, is is the market the safest place to be?
Well, first of all, I'm 65, and this is the most speculative market I've been through. Nothing comes close. That includes the internet bubble from the 2000 top. This is way more speculative, way crazier. There's a lot of ways to measure that. You can measure it by margin usage. You can measure it by public participation. You can measure it by market valuations, stock valuations. There's a lot of ways to measure it. And so to answer your question directly, I want to be clear. I don't forecast the markets. Remember, I said earlier, that's not a valid
Right.
approach. So I don't
Right.
do any market forecasting. Nothing that I teach is regime dependent. So what you're doing is you're describing the regime we're in right now. Everything I teach is timeless. It works across regimes. So it's working beautifully right now. My clients are getting excellent returns. And I shouldn't say clients because they're students. I don't sell
Yeah.
money management, right? I sell services and education, but I do not sell money management because it's a conflict of interest. And so my students are getting excellent returns in this environment, and they've been all along, and they're continuing to get excellent returns, all the while carefully managing risk for when this falters. So there's no opinion of Todd involved. All the opinions of Todd are built into the algorithms and how all this is properly constructed, how you build a smart portfolio, how you manage risk, how the disciplines select the correct markets to participate in, what allocations it does to each market at each time window. So all that's built into the math, but it's none of my opinion. Okay. I don't have any opinion on it whatsoever. So with that said, I do want to point out a couple things. Okay. Yes, there's a lot of speculative gains being made, whether it was crypto before or it's the AI bubble now. Stocks are hitting all-time highs as we record this. One thing people are missing out on is really key to look at, and is probably going to be the key to the future, is the bond market. The bond market's 50% off its highs from, I forget the exact date, 2020, 2021. It had a 50% loss as we came off 0% interest rates and went to something halfway reasonable interest rates. And so half the value got wiped out, and it's crawling right along the bottom. It's never even bounced. It hasn't even had a dead cat bounce. I mean, it's just crawling along the bottom. It's right near the all-time lows. The way to measure this is to look at the TLT ETF. That's the long bond ETF.
Okay.
So again, you don't have to take my word for it. Just go look at the chart for it and you can see. So on a 60-40 portfolio, almost half that portfolio got wiped out 50% and is crawling along the bottoms. People aren't worried about it because their stocks are still running. But a really interesting thing we're seeing, so not only are we seeing that bonds are having a massive problem in this environment, gold is running. Gold is a fear trade. So pay attention to that. That's telling you something. The fact that bonds are dead in the water and crawling is telling you something. The fact that gold's running is telling you something. And the fact that stocks are speculative and overvalued is telling you something. You're in a very high risk environment right now. Now, it's masked because it's stable. People mask current stability today, last month, last year. It's been remarkably stable. It surprised me. If you had asked me to forecast it, I would have told you no way.
Yeah.
I would have thought this thing would have broke long ago, but that's why I don't put any money on my opinions. I have opinions and I'm very well educated on this stuff. I know this stuff pretty well. I can
Right.
actually, we tested it when I had the hedge fund. We had me actually try to outtrade the models. And I was right. I was better than the models probably 70, 80% of the time. But the 20% of the time that I was wrong, it would cost us so much that we were better off 100% in the models, because I'm a human like anybody else and I get attached
Right.
to my opinions, right?
Right.
And so if I make a mistake, the models make mistakes, but the thing about the models is they self-correct very quickly. So they're never very far from right. They're always approximating and readjusting and trying to find the next position that's going to be favorable. And they're always cutting losses very quickly. Whereas I would get attached to my opinions and I would make mistakes. So even though I was more accurate than the models, 80% of the time, let's say, the models would still beat me consistently, because when I made a mistake, it would cost too much. And that's what humans do when you involve human judgment. And that's why I don't put any of my own capital on it. And I teach students not to put any of their capital on their judgment.
So, and yet it seems like and I've got to be careful here. I want to be sensitive to this, but we have a lot of investors, a lot of individuals planning for retirement who have accepted this passive role and said, listen, this is too much for me to know. And I'm going to put my money with a financial advisor. That financial advisor's going to really pay attention to my money and manage that for me. They're going to move it as they should be moving it. Is that really what's happening? And how much time does it take your students to really manage their portfolio, if you will?
Less than an hour a month.
Okay.
So it takes my students 3 months of solid part-time effort to learn the ropes, right? I mean, it's not a small course. There's knowledge behind it, and it takes some time to learn it. And you're basically adopting a completely different worldview of how financial planning as well as investment strategy operates.
Okay.
And so you have to undo a lot of myths that are taught in conventional wisdom and replace them and build a different model that's a more effective model in your head that governs your decision framework. So you pay a little price up front to learn it, but once you know it, you know it. And what my students tell me is once you know it, it's obvious. Like they don't understand why finance hasn't always been taught this way. It's not complicated at all. As a matter of fact, it's less complicated because it's actually a cohesive system. It there are no anomalies. It takes all the anomalies out of conventional personal finance and it's embodying them into how this is taught. So there are no outliers and anomalies and nonsense things that you have to adjust for, like in conventional finance. It's all built in and it works. So once you learn it, the models are done by a service online. You're not maintaining the models. You're not maintaining the data. You're not doing any of the heavy lifting. You pay all of $400 a year to somebody else. It's not even mine. You pay $400 a year to somebody else. Now you want to buy it through me because I provide all the education for how to do it. And I include that for free if you buy it through me, right? Because I get paid as an affiliate.
Okay.
So there's no reason not to buy it through me. But my point is you're not paying me. The service is run. It's excellent. I know the guy. He's as persnickety as I am, and he knows his math like I do. And so anyway, you're not doing the heavy lifting on it. That's why I said it takes you like a month because all you're doing is you're getting all the updates from the software and then you're making the adjustments in the portfolio. So it doesn't take long. I want to address something that was kind of implied in what you said, which was, conventional wisdom says to do, everybody's buy and hold right now. I mean, passive investing is the thing. So there's a couple of things to understand if you look deeper in market history, which is investment trends go through cycles, long cycles. And the truth of any given time is almost entirely defined by the prior cycle that you lived through. So for example, anybody can find this online, go find Your Battle for Investment Survival by Gerald Loeb. It's spelled with a G, Gerald Loeb, Loeb. You can get it for free online. I've seen the PDF available for download free online. Or you can just buy the book cheap on Amazon. It's not that it's a particularly great book other than to understand context. Okay. That book was the Wall Street Journal bestseller back in 1935, which is after the Great Depression. And so that book completely advocates for a completely different style of investing than you would get today. It's all about stock selection, being intelligent, managing risk, all these things. I'm not talking about stock selection here, but the other things I'm talking about in principle, right? There's not a word of passive investing or ignoring volatility in that book. Why is that? Because he would have been burnt at the stake if he had said that after the Great Depression, right?
Right.
It's that book and the wisdom of the time is a reflection of what preceded it. It's the same thing here. We've had an activist Fed since 1980, beginning with the Greenspan era. Right? Paul Volcker set things up very well, and then Greenspan began the plundering of the country. And so that whole Fed permissiveness and activist Fed is what's created a low volatility, rising valuation environment. So we've had a tailwind for, 45, 50 years. But we went to
Yeah.
0% interest rates. It can't go any further. It's already begun its reversal. We're at the highest market valuations in all of history. There's a reason market valuations have a ceiling. It doesn't mean they can't go higher, but there's a math reason why those have a ceiling. You're pricing the value of a business as the discounted present values of its cash flows. And so there's logical boundaries to what can go, how high it can go. And we're up there. We're up there. There's a business valuation criteria by which that boundary is set. And so, yeah, I get that passive wisdom has worked beautifully. And that's why everybody is on one boat. But that's never good for the future. If
Yeah.
it's so conventionally known as to be indisputable truth, and we're going to string Todd up by his thumbnails for having advocated anything different, right? I mean, here he is. I'm speaking heresy. This is like
Right.
going into I'm walking into a Baptist church and questioning the existence of religion, right? It's insanity, but I'm trying to honor what's true and what I know is mathematically true and provable
Yeah.
based on market history. And so if you understand deep market history, you understand everybody's on one side of the boat. We don't know when the passive bid's going to stop supporting the markets. We don't know when the Fed will, but we're closer to the end than the beginning. I can assure you of that. And when it does change, there's going to be a lot of people surprised, and you don't want to be in that group.
So this has been so helpful. I'm really grateful for your time and for kind of giving us an opportunity to pull back and think about the half truths that we've been taught for so long. If you're advising, and you're not an advisor, but if you're educating those that are listening, they're here obviously because they're at a stage in their life where they want to protect this next nest egg that they have been saving so long to be able to build and live the retirement they want. What's your advice to our listeners? Give me 2 or 3 things that you think our listeners should take away from this and go and do. I'm gonna start. I'm gonna give 1, and then you can find 3. 1 is you need to go right now to financialmentor.com and engage in this course. I think it's going to make a difference. It sounds like it could make a monetary significant difference in your retirement and in your future. But give us 3 takeaways, if you will, or 1 or 2.
It's really,
Three's no magic
it's really
number.
hard because there's a body of wisdom that creates an entire understanding of how this works. I can sit here and just field your questions because I'm coming from a singular body of wisdom, and I just start connecting all the ideas because they're all connected.
Right.
Right. So, you can ask me about market risk and unmanaged market risks. Bam, off I go. You can ask me about volatility. Bam, off I go. Right. It doesn't really matter what topic you do. I'll show the myth of it and then connect it to the entire body of wisdom. It's like when we're talking about, passive investing, right? Here's an idea just to throw into the mix, and then I'll get back to your question. I'm not trying
Yeah,
to
no
evade your
problem.
question. What activity in your life is optimized through a passive approach? Take career, spirituality, health, your finances. Is there any, I call them process-oriented activities, right? Is there any activity in your life, process-oriented activity, that that is optimized through a passive approach? The answer is no.
Yeah.
There's not one exception. So what makes you think investing is the exception? It's not. I had a course student the other day point out something really interesting to me. This course student is really knowledgeable. He was part of the Boglehead community. He's part of the FIRE community, really knows his stuff. He's a huge fan of my work now because it goes way beyond what those communities are teaching. But it incorporates what those communities are teaching. It shows the myths behind what they're teaching. And so he was saying it's interesting because he works with a group through his work. He leads a FIRE group, so FIRE community group. And he says it's really amazing because in my community, everybody's walking the talk. Like they've done the work, they've gotten involved, they created their own wealth plan, they're taking responsibility for the investments, they have agency, and they're walking the talk. Their actions are congruent with the instruction. He said in the FIRE group, what strikes him is these people claim they're FIRE enthusiasts, but they don't walk the talk. They don't actually do what it says. And it really struck me when he said that because I realized, well, that's the absolute truth for people who hire a financial advisor, right? The more passive you are, the less you actually walk the talk of doing what it takes to achieve the goal, right? So when you delegate to a financial advisor, you think that's smart, right? Because you delegate to a plumber, you
Right.
delegate to an electrician. But this is totally different. This is not analogous to those two. In those two, you hire somebody, they produce a result, you pay them, and they're gone. This guy ongoing is collecting a fee based on a percentage of assets, and there's various other ways that the person gets paid. There's a conflict of interest, and it's separating you from your money, right? But you're making financial decisions every day, every week, every month that determine the financial outcome of your life. You can't delegate it. You can delegate I got to get this right. You can delegate the authority, but you can never delegate the responsibility. Ultimately, the responsibility is you because you're making the decisions. So the more distance you are from that responsibility, the worse your decisions are. And that's what I noticed when that student told me that.
Interesting.
Because he's saying in the course, everybody's walking the talk. They're doing what you taught. They're living it. Why? Because they got actively involved. They're engaged. They're actually learning. They're taking responsibility. They have agency. In the fire community, it's short, it's quick, it's passive. They don't have to, they're not as close to it. So some are walking it, some aren't. Some are doing parts, some aren't. And then on the flip side, the further away, which is delegating to a financial advisor, they're doing even less. And that costs you. That's taking away your future fortune. You're paying a price for it. And so the question is, what price do you want to pay? Right? What price because you're going to pay a price for any decision. Do you want to spend 3 months? Do you want to spend 3 months learning and taking agency and taking responsibility and have a lifetime of improved results? Or do you want to just delegate it and pretend that it's going to work out? You're going to pay the price either way.
Yeah. I love this. And you're not, and you, so I'm going to just summarize these last few things that I think you just said, and that is, listen, it's time for you not to ignore volatility, and it's also time for you to not be passive in your investments, especially in your retirement. It's such a tragedy for me to see how many people, their whole life, look forward to retirement. And when they get to retirement, because they've been passive, they don't understand what they have and how to manage it. They let fear really drive their plan. And usually that fear means, I'm not going to touch that amount of money. I'm going to live on Social Security in the very least amount I can. I'm not going to spoil my grandchildren. I'm not going to go play golf with my friends. I'm not going to go on that vacation. They don't touch the mountain, and they end up leaving that mountain to their posterity. And they go on their vacations, and they go and play that round of golf. And now's the time. If you want the retirement you have worked for, have dreamed of, now's the time for you to engage. And I'm going to leave personally, and I'm going to go to your website, thefinancialmentor.com, 2 words, 1 URL, and I'm going to look into getting a copy of and studying Expectancy Wealth Planning course. Todd, I'm so grateful for your time today. Thank you so much for sharing and being so open and bold. We needed it.
Yeah, thank you for having me on the show. I appreciate it.
You bet. Thank you. Ladies and gentlemen, thanks for tuning in to another episode of Safe Money Radio. There are free downloads available at safemoneyradio.com. Listen to us next time and join us so we can help you worry less and live longer. Thank you. Thanks for listening to Safe Money Radio. If this episode gave you something useful, will you consider sharing it with someone in your life who is close to retirement? That's how the show reaches people who may benefit from our plain language retirement income education. 2 things before you go. The Safe Money Guide is available at no cost at safemoneyradio.com. It's written in plain language, designed to help explain retirement income concepts, and includes how annuities may work. If you are ready for a conversation about your own situation, you can book a no-cost strategy call with a licensed insurance agent in your state directly from safemoneyradio.com. Now, just one word. I actually meet with the first few individuals who apply for a meeting each week on that site. Now, there's no obligation to purchase. The conversation is intended to help you understand your options and whether an annuity may be appropriate based upon your individual circumstances. I'm Brett Blake. Until next week, worry less and live longer.